Before we delve into the potential inflationary or deflationary consequences of the RV and the influx of 100T ZIM bonds notes, let's clarify the assumptions. Gold-backed USD. We're assuming the USD will be immediately gold-backed post-RV. Massive ZIM infusion. There will be a significant influx of ZIM bonds notes into the global economy. Price impact. We're interested in how this scenario might affect prices broadly. Potential outcomes: inflationary pressure, increased money supply. The massive infusion of ZIM bonds notes could significantly increase the global money supply. Increased spending. If people perceive their wealth to have increased due to the ZIM, they may be more inclined to spend. Demand pull inflation. If demand for goods and services outpaces supply, prices could rise. Deflationary pressure, gold-backed USD. A gold-backed USD could theoretically limit inflation as the quantity of money would be tied to a finite resource. Increased productivity. The RV could stimulate economic activity and increase productivity, potentially leading to lower costs and prices. Reduce spending. If people become more cautious about spending due to uncertainty or a shift in economic mindset, demand could decrease, leading to deflationary pressure. Factors to consider: velocity of money. How quickly money circulates in the economy will significantly impact price levels. A higher velocity can lead to inflation, while a lower velocity can lead to deflation. Global economic conditions. The overall state of the global economy, including factors like interest rates, trade policies, and geopolitical events, will also influence price levels. Consumer confidence. If consumers are optimistic about the future, they are more likely to spend, potentially driving prices up. Conversely, if consumers are pessimistic, they may be less likely to spend, leading to deflationary pressure. Conclusion. Predicting the exact impact of the RV on inflation and deflation is challenging and depends on a variety of factors. While the influx of ZIM bonds notes could potentially lead to inflationary pressure, the gold-backed USD and other economic factors could mitigate these effects. It's important to monitor the situation closely and consider the interplay of these various factors as the RV unfolds. The concept of a gold-backed USD post-RV signifies a return to a monetary system where the value of the US dollar is directly tied to a fixed quantity of gold. This system, reminiscent of the classical gold standard, implies that the Federal Reserve would be obligated to hold gold reserves equivalent to the currency in circulation. In essence, every printed dollar would have a tangible asset backing it, theoretically ensuring stability and limiting the government's ability to manipulate the money supply. The RV, or revaluation of various assets, is expected to inject significant amounts of liquidity into the market. This sudden influx of wealth, coupled with a gold-backed dollar, presents a complex economic scenario with potentially profound implications for inflation and deflation. Understanding these dynamics requires careful consideration of both sides of the equation. The immediate aftermath of an RV could see trillions of dollars flooding the global economy. This surge in liquidity, fueled by the revaluation of previously undervalued assets, could trigger a rapid increase in demand for goods and services. As more money chases a limited supply, basic economic principles suggest that prices would rise, potentially at an alarming rate. This scenario aligns with the classic definition of inflation: an increase in the general price level of goods and services in an economy over a period of time. A gold-backed dollar, while intended to provide stability, might struggle to contain this sudden and massive influx of wealth. The sheer volume of new money entering the system could overwhelm the stabilizing effects of the gold standard, at least in the short term. However, the gold-backed nature of the USD introduces a critical counterforce to this inflationary pressure. With a finite amount of gold backing the currency, the Federal Reserve's ability to print money becomes inherently restricted. Unlike the current fiat system, where money creation is theoretically limitless, a gold standard imposes a tangible constraint. This constraint could act as a natural brake on inflation. While the initial influx from the RV might create upward pressure on prices, the limited supply of new dollars would eventually curb excessive spending. The inherent scarcity of gold, and by extension the gold-backed dollar, could prevent runaway inflation, a phenomenon often associated with unfettered fiat currency systems. Section 4. Irrational exuberance or prudent savings predicting spending habits. The outcome of this economic tug-of-war hinges on a critical factor: human behavior. How individuals react to this newfound wealth will significantly influence whether inflation or deflation takes hold. Will people succumb to irrational exuberance, spending recklessly and fueling a rapid price spiral? Or will they embrace a newfound sense of financial prudence, opting to save or invest their wealth cautiously? Historically, periods of sudden wealth injection such as gold rushes have often been marked by both extravagant spending and shrewd investment. Predicting which behavior will dominate in a post-RV world is a complex task, influenced by factors ranging from individual risk appetite to overall economic sentiment. Section 5. A tug-of-war: inflationary pressures versus deflationary forces. The interplay between the inflationary pressures of increased liquidity and the deflationary forces of a gold-backed dollar creates a complex economic equation with no easy answers. On one hand, the sudden influx of wealth from the RV could ignite a surge in demand, pull inflation, pushing prices higher. On the other hand, the inherent scarcity of a gold-backed dollar could act as a countervailing force, limiting the Federal Reserve's ability to fuel inflation through excessive money creation. The ultimate outcome will likely depend on the degree to which these opposing forces balance each other out. Section 6. A golden future: navigating the uncertain terrain. Predicting whether inflation or deflation will dominate in a post-RV world with a gold-backed USD is a fool's errand. The reality is likely to be far more nuanced, with periods of both upward and downward price pressure. The initial shock of the RV might indeed trigger inflationary tendencies, but the long-term impact of a gold-backed dollar could usher in an era of relative price stability. Navigating this uncertain terrain will require vigilance, adaptability, and a deep understanding of the underlying economic forces at play. While a gold-backed dollar offers the promise of stability, it is not a magic bullet. Prudent fiscal policies, responsible monetary management, and informed individual decision-making will be paramount in navigating the post-RV economic landscape. Do your own research. Please subscribe and follow Seeds of Wisdom team. They care about facts.